didn't take long for reality to catch up with the speculators. When prices of companies are multiplying by factors of 10, sometimes 20, in such a short period of time, it's almost certain that this is being driven by a form of irrational exuberance and not by an actual increase in the company's future payoffs. So, unsurprisingly, the 1720 bubble ends just as rapidly as it starts. In the span of just a few months, both the share prices of the South Seas Company and the Mississippi Company would collapse back to the levels that they were prior to the mania, which had started earlier in the year. One of the main reasons that the bubble burst started in France. It was doubtful that various investors would be able to actually get the money that John Law claimed was going to be available. They started to demand to cash out. And of course, the way that the Mississippi Company cashed out investors was simply by paying them in paper money, something that it controlled. Now, this didn't sit well with many investors who began to demand that they be cashed out, not simply in terms of paper, but in terms of specie, something that would have been absolutely impossible given the massive expansion of the money supply which had occurred over the course of the prior year. As investors started to demand to cash out and realizing that they simply could not, share prices began to rapidly collapse. Even though this trading was suspended for some periods and there was a bit of a bounce down the staircase, nonetheless, within just the span of a year, shares of the Mississippi Company had fallen by as much as 90%. And if we were to consider that value in terms of their actual metallic value rather than a paper value, they would have fallen by as much as 99.9%. Meanwhile, shortly afterwards, when the Mississippi Company had begun its collapse, the South Seas Company seemed to have sprung into action, or at least speculators moved from one market to the next. In order to try to keep these new wave of speculators focused on the South Seas Company and not others, the directors of the SSC petitioned the British government to pass what was called the Bubble Act, which would limit the issuance of new shares to companies who were in possession of royal charters. Now, of course, what they had hoped to do was to block any of these new companies which were emerging and funnel all of this new capital into their own shares. Instead, what it did was terrify capital markets about the idea that general business plans might not be acceptable, as no charter had ever provided for such a thing, and that it would be impossible for many of these new ventures or even to issue any kind of capital at all. The wind immediately flew out of the sails in the British market as well. On the left panel, you can see here that the first to peak was, in fact, the Mississippi Company. Starting off in 1719, things seemed to simply explode around the middle of the year, finally peaking around the end of the year, fumbling along at the top for a few months, and then rapidly beginning to collapse as investors realize that they have no way to get their money out of the firm, which is clearly not going to be delivering the promised 40% dividends. Meanwhile, as money flowed out of France and perhaps into the English market, we see the South Seas Company price not only doubling within the market, but then suddenly almost tripling from that point forward in a short period of time before itself rapidly collapsing after the passage of the Bubble Act. In the right-hand panel here, you can see we've got the share price of the Mississippi Company itself in blue. It sort of mimics what you see on this left panel. But in green here, as the price begins to collapse, we see the share price in constant amounts of silver, indicating just how badly value had ultimately been destroyed by the overinvestment in the Mississippi Company. Now, unsurprisingly, after such catastrophic collapses in both markets, where fortunes were lost by several people, moral outrage ensued. They began with the publications of series of pamphlets lampooning the speculators. Plays were performed, making clear fun of them, and a lot of these immoral aftermath over the year and a half after the bubble burst was collected into a book several years later called The Great Mirror of Folly, which was recently reissued by Yale University. You can find some of that information here. But there were some serious political and financial after effects of this, not simply people hand-wringing in the streets. Given how much money had been lost in the UK, the government decided that it would keep the Bubble Act in place, not for a little while, but in fact for over 100 years, preventing the emergence of large-scale public enterprises in Britain beyond those that already existed, effectively limiting the control of large-scale enterprises to the relatively small financial oligarchy who already controlled them. In France, things were much, much worse. because everything had been concentrated into the Mississippi Company. When it fell, it literally took the entirety of the French market down with it. In England, things had been bad and many companies had suffered, but a number of firms like the East India Company or the Bank of England endured. In France, everything failed when the Mississippi Company failed. In fact, it became so bad that people began to distrust paper banking. They started to distrust the entire idea of a central bank. They distrusted the idea of investing in equities. And of course, this made it really challenging for France to be able to gather together the household capital it would need to be able to compete on an imperial scale. And we see throughout the 1700s that France's imperial power begins to wane. Ultimately, the crown finds itself in a position of having to raise taxes fairly continuously to pay for its rather expensive nobility-only welfare state, which in turn ultimately turns to the French Revolution in 1789. The final chapter in France's drama on Mississippi occurred in 1803 when the French under Napoleon finally sold themselves of the difficult territory, selling it off to the Americans. Now, there are some important lessons that we can draw in general from the experience of the 1720 bubble. First, the process of engraftment, the repackaging of debts effectively into a more marketable format, what we would today call securitization. This doesn't actually change the value of the underlying asset in terms of the probability or magnitude of the cash flows that it will generate, but it might be able to increase value a little bit if we have better liquidity in a unified pool of assets as opposed to people trading individual bond issues. When we take a look specifically at the firms involved in the South Seas bubble and in the Mississippi Company bubble, we see that both of them are actively engaged in trying to manipulate their stock prices. And it's not just the managers who are doing this. These are the directors of the firm who are supposed to be looking out for the best interest of their investors. Instead, they quite clearly appear to be looking out for themselves. The excess liquidity in the market that they both engendered absolutely made things worse. But what's important to recognize is why the manipulations worked. The manipulations were able to work because there was a space in which investors could not directly monitor themselves. Without the ability to monitor, they simply had to take people on their word for it. And that meant believing John Law when he said that the natives were handing them gold and were very friendly to them, when in fact people were dying like flies. The involvement of reigning monarch and other elites seemed to almost certify the merits of both the claims that were being made and of the potential for the future that each firm represented. One other thing that's interesting to consider, though, is that when we look at the stock market bubble of 1720, a large part of this may have revolved not simply around deception, but around a changing regulatory structure. In a paper written by the author of our textbook, William Goatsman, he points out that there was significant bubble in a number of British ventures around this particular point in time, not simply in the South Seas Company that we see here in purple. The South Seas Company may have reached up by a span of 8 times over the course of a year in terms of its stock price, but there were other companies like London Assurance who saw its stock price multiply by 45 times over. Even, again, larger than the South Sea Company bubble was Royal Exchange Assurance, 2 particularly large insurance companies that were hoping to benefit from the idea of being able to write any kind of insurance, not simply shipping insurance or fire insurance, as had been the standard in the days of fixed royal charters. As soon as the Bubble Act passed, though, and it confirmed that companies would only be able to work in very specific lines which they had been chartered to, the value of these companies necessarily collapsed. Not because there had been anything necessarily wrong with their operation, but simply because the expectation of future growth that had suddenly seemed so high was suddenly snuffed out. Now, when we look at the overall impact, one of the things to consider is how the stock market changed financing over the next 100 years. In general, what happened is that the trading of equity became very much an insider's game. If you were not directly involved or associated with the company, it was very challenging to be able to overcome the sorts of social and cultural memories of the 1720 bubble. Most people were simply turned off by the risks associated with it and the knowledge that there had been such open and rife manipulation. And as a result, we actually see potentially a slowdown in industrialization for almost 100 years.